Hello, everyone, and welcome to LPL Market Signals. Jeff Bookbinder here, your host for this week, with my friend and colleague Adam Turnquist. It is a special holiday week edition of Market Signals. So, Adam, with your help, we're going to talk about some of the most important charts of 2024. So, how are you today? Thanks for joining.
I'm good. Riding a Vikings win, a fantasy football win, and we're talking charts today. It was pretty hard to narrow down 7 charts for me. As you know, you've seen some of my other presentations. They get a little chart heavy, but we got it down to 7 really interesting charts for today. So looking forward to discussing those with you.
Yeah, if you ever want to do like a top 50 chart podcast, just let me know and I'll make sure I find somebody else to host that week.
Right.
No, just kidding. I love each and every one of your charts, just like my own children, no matter how many there are. So here's our agenda for this week. So market recap, of course, as always. We'll talk a little bit about the Fed and the hawkishness, what that meant for stocks last week and going forward. But of course, the majority of the presentation will be about the year in charts. So thanks, Adam, for narrowing it down to 7. We'll call it the lucky number 7, although I guess we're not counting just a general performance chart up front. So you want to do 7. It's lucky. And then the week ahead is going to be very, very short. It's a holiday shortened week, of course. There's not much meaningful data. So let's get right into it. I mean, of course, a lot of red last week, right? We had the S&P down 2% on the week. Similar declines for the Dow and the NASDAQ. The Russell 2000 was an outlier to the downside, down over 4%. So clearly it was a risk-off week, and you'd expect small caps to struggle in that environment. Add to that, it was a rising yields week, so that certainly made it tough on small caps. So, Adam, your take on the sector performance last week. I mean, I noticed that it was a tough week for energy on the the dip in oil prices. Anything else stand out to you in terms of the sector mix?
I think just the degree of selling pressure across the sectors. Everyone was talking about breadth last week. As a technician, I don't remember ever seeing headlines about market breadth at that level as of last week. We had 14 days of negative breadth for the S&P 500. So the worst breadth of the year. On Wednesday, we had that big relief rally on Friday. That was the best breadth that we've seen in terms of advancers versus decliners. But overall, the trend there, lower and lower participation in this latest leg higher. Few hiding places last week, as you can see, really across the 11 S&P sectors. Energy leading losses, with crude oil really going nowhere fast, kind of just stuck down around $70 a barrel, holding above support, but still in a downtrend. So it was certainly a wild week for markets, not only in equities, but also in fixed income, as you mentioned, with yields moving notably higher.
Yeah, I mean, you're right. All sectors were down. It was broad based, but you had a pretty big discrepancy between, the winners, mainly tech, down less than 1%, and then energy down over 5%. You ended up with another growth-led week. Growth outperformed pretty meaningfully, as it has for the last 3 months, year to date, and for the trailing 1 year. And I think another story, and again, this was about Fed hawkishness, right? With the Fed meeting. That hawkishness combined with dovishness out of the Bank of Japan led to a strong dollar. And when you have a strong dollar, it's very difficult for international equities to keep up with U.S. equities, or it's difficult for them to fall less than U.S. equities. So indeed, we saw for U.S.-based investors, the EFA and the EM index did lag the S&P 500. So turning to the bond market, yields are up. In fact, were up over 40 basis points in just 9 trading days through last Thursday. So we've had a really big move in yields, kind of settling in the 450 range. So you see another down week for the Bloomberg Aggregate Bond Index, and you see the year-to-date returns for that index only 1.3% positive. I mean, it's going to be hard to erode much more of that at this point, but certainly a frustrating year for the bond market, broadly speaking, although certainly we had some winners with high yield this year, as well as preferreds. Preferreds have been an area that we've liked all year, and continue to like among plus sectors for fixed income. How about commodities last week, Adam? Anything jump out at you there besides more weakness in crude?
The nat gas story has been interesting. You can see there trading at 372 today. That's above the 2023 high. So technically, that's a big breakout in nat gas. There's still a lot of short positions in the futures market. So there's potential for a squeeze there higher. Part of that story has been due to just the colder weather. Living here in the Midwest, you look outside, we got a lot of snow last week, a little bit colder temps. That's helping partially clear that supply demand story for natural gas.
Got some of that in the Northeast too. I think we bottomed at 5 degrees overnight and got about 5 inches of snow here in the western suburbs of Boston. So yeah, that certainly can help natural gas, no doubt. So thanks for that, Adam. Let's keep rolling. I mean, I guess just in terms of what we like, we do like precious metals. Generally, we do in the short term think the dollar is probably more likely to rise than fall. And generally speaking, we think commodities can be a decent place to be in 2025, as we wrote about in our 2025 outlook, which we released a couple weeks ago. So let's do the S&P chart here, Adam, real quick before we get to your 7 key charts of the year. We still got an uptrend, but clearly we've had a little bit of technical damage.
Yeah, certainly last week testing the S&P 500, you can see on the top right there, it violating this shorter term uptrend. It did bounce back on Friday, what we call a bullish engulfing candlestick. So the entire trading range encapsulates the prior day's range. Usually it overlaps with a potential inflection point, but getting back above that 50 days was a good sign. Keep an eye on that level this week in terms of support. We start breaking the 50-day or 58.60. That's that post-election day price gap for the S&P. You have to question if we're going to go retest the 5,700 support level. That would be one of the next major areas. And even the rising 200-day moving average, not too far down from current levels, around 55.26. That would be about a 10% correction. So nothing out of the ordinary in terms of a drawdown for the index. And you can see when you look at the internals of the market, the damage that was done last week, that middle panel highlights the percentage of stocks above their 200-day moving average on the index. The low for the year was 63%. We have that green support line. You can see how that percentage had bounced off that level numerous times throughout the year. What changed last week, we put a new year-to-date low in the percentage of stocks above their 200-day moving average at 55%. So I consider that a yellow flag in terms of market breadth. If we start going below 50%, that would be the red flag. That would imply less than half the index in an uptrend. And then on the bottom panel, we're just highlighting the advancers versus decliners, that daily breadth metric, down 14 days or negative breadth, meaning decliners outpacing advancers. Of course, we saw that flip on Friday with that relief rally. So that's another thing we'll be watching this week in terms of just what's the rebound here in breadth as we get through this holiday shortened week.
Yeah, a lot of action late last week. You had, of course, the hawkish Fed, which, I mean, frankly, we think at this point expectations are probably pretty realistic for 2 cuts next year, although maybe the market was a little surprised by the big increase in inflation expectations from the FOMC. Nonetheless, we got a good core PCE inflation number on Friday, and we averted the government shutdown. So, generally, there's a little bit of an upward bias here. As we're recording this, it's Monday afternoon, December 23rd. So, I think looking forward, you've got a little bit of chart test to pass here, I would say, but the fundamentals to us still look pretty good. We got through some of the big milestones of December, and we'll probably just sort of drift through to into 2025 here. At least that's my best guess. So thanks for that, Adam. Let's go to the year of charts, the year in charts. 7, I know it's hard, but you've narrowed this down to 7 most important charts. We're really just trying to give you an overview of what happened in 2024, at least
the performance, or I should say outperformance for that group of stocks this year. Another year where mega caps dominate. And then we'll look at large versus small. We've had a lot of excitement in small caps. If you think back to December of last year, small caps rallied. Everyone was making the call. It's going to be the year for small caps. We'll highlight the chart that suggests otherwise, with large caps really dominating. One of the other areas at the sector level, communication services, outperforming this year, all 11 S&P sectors. I think a lot of people might be surprised by that when you look at just the focus on tech. Volatility was low in 2024. We'll look at the VIX and just maybe a little bit of an outlook as we forecast for 2025 for volatility. As we know, it tends to mean revert. So there's a little bit of a hint we could have a more normalized volatility year as we look ahead. And then yields, another one that's this paradox with the Fed finally starting to cut interest rates in September, but yet here yields are higher. I have to remind my wife of that every time she asks about refinancing. When the Fed cuts, rates moving higher, and I have to go through the whole explanation of the market is forward looking and has expectations. So I think that 10-year chart, a very interesting one this year. And then sentiment, we'll look at that through the conference board, but really a one-way street. Everyone seems to be kind of all in on equity markets. Last but not least, gold, precious metal here, actually outperforming the S&P 500. Another one that I think surprises a lot of people. When you think about the backdrop for gold, you have a higher dollar, you have rising real yields, but yet gold has had a pretty resilient run here in 2024.
Yeah, if you came up with the top surprises of the year charts, I think you'd probably have some of these same ones. So let's get into it. So you're setting, just to set this up, this is just a broad performance chart. So we're not counting this as one of our top 7, but it sure makes a point that the mega caps were the place to be.
Certainly, and this is an equal weight Magnificent 7 index price return. So we're not including any dividends or anything like that. Up 72%. That compares to the equal weight S&P index in copper, up 11.5%. Still a very good year for the equal weight index, but you can just see how much outperformance there's been in those mega cap names compared to even the cap weighted S&P, up 24%. If you look at the contributions to returns this year of the mega caps, you include Broadcom because of that big rally we've had in Broadcom over the last couple of weeks. They've contributed about 60% to the S&P 500's overall year-to-date return. I think NVIDIA alone has added about 20% to the S&P 500, second to Apple, contributing 8%. So it's really been a NVIDIA world that we're living in this year and really helping drive that mega cap space higher. So when you look at the weights of the Mag 7 as well, they're just under a third of the S&P. So outkicking their coverage in terms of their contributions this year to the overall index.
Yeah, I think this is why you use technicals, right? People were calling for this rotation at the start of last year, and we just didn't get it. You got a little bit of fits and starts, we'll call it, but until the charts tell you that you're making a turn, we're not going to make the turn. So I congratulate you, Adam, on helping us avoid that trap. So more on the Mag 7 theme. You can't talk about 2024 without talking about Mag 7 strength. That bottom panel really shows how strong this segment of the market's been.
Yeah, certainly. They've been a consistent leader really since the bull market began, and they got a little bit overbought. If you flash back to the summer, you can see even on the top panel, the Mag 7 index, an accelerated rate of change, and it went into kind of this consolidation phase. And there was a lot of questions about this big rotation. Is it time to go to small caps or value and move out of kind of the big tech trade? However, it ended up being just a consolidation, and that's technically what you see a lot of times. You have these outsized returns in an asset class, you consolidate, some of those gains are digested, you reset expectations, and then you resume in the direction of the prior uptrend. And of course, for the Mag 7, that's been higher, finally breaking out through those July highs. We were watching and waiting for that as technicians. And then we also got the breakout on that ratio chart. This is comparing the equal weight Mag 7 to the equal weight S&P 500, also rallying to new highs. So as we search for relative strength, this is really what you want to see. Breakout in absolute terms, breakout on a relative term. as well. So pretty impressive rebound here, or rally into year end, reasserting themselves as market leaders as we go into 2025.
Yeah, we do think you get a little bit of a slowdown in this outperformance in 2025, consistent with the earnings gap closing, right? So we're starting to get more earnings growth out of the rest of the market, while the Mag 7 earnings growth is slowing. Another theme we talked about in the 2025 outlook, that performance should follow earnings over time. So maybe the Mag 7 outperforms again, but we certainly wouldn't expect it to be by quite this much. So I feel like a lot of these charts, even though they're different, are tied to the same Mag 7 theme, Adam. So this is large over small.
Yeah, kind of a follow the money type of chart here. And these are more ratio charts that we use to identify where the relative strength is, where that trend is, how sustainable is that trend. The top panel is the large cap S&P 100. We're comparing it to the S&P small cap 600. This is the cap weighted versions. And we often get pushback. Well, it's just the large cap names or the mega cap names really doing all the work. So we also included the equal weight S&P 100 and the equal weight S&P 600 chart on the bottom panel, just to give a little bit more apples to apples comparison. But you can see really throughout 2023 and again 2024, it has been large caps leading. That's exemplified by this ratio chart moving higher. And there's certainly been some tests along the way for these ratio charts. You can see, talked about earlier, just that excitement going into 2024 with this big rally in small caps in December of last year. We bounced right off the lower end of that channel. Same thing in July. We had a big rally in small caps. That was, everyone was on TV talking about small cap leadership and why you should be in small caps. But again, you had large caps reassert themselves. Same thing post-election rally in small caps. We've had a bounce right near that 200-day moving average, lower end of the channel. And again, not just on the cap weighted, but also on an equal weight basis. So for now, that's where the trend is telling us for next year, at least technically here, that large caps will likely continue to lead.
Yeah, you're getting better earnings growth out of large. Small caps are interest rate sensitive, so we're in a period where we're digesting higher rates. And frankly, we don't think we're going to get too much good news on the tax cutting front over the next 6 months. So it's going to be a tough negotiation next year. And the tax cuts wouldn't come until 2026 anyway. So we think maybe market's getting a little too excited about overweighting small caps here. We're more of a cautious neutral, waiting for a dip to potentially buy. So next up is comm services. This has been another winner for LPL research. Actually, in our weekly market commentary in January on LPL.com, we're going to talk about what we got right and wrong in 2024. And this is certainly going to be in the right column because this has been a big winner really all year.
Yeah, it's been in a consistent rising price channel, as we highlight here for the sector. Coming out of this, what we call a head and shoulders bottom formation. You can kind of see the left shoulder, the head, right shoulder, and it's consistently been in an uptrend ever since breaking out. And when you look at it on a longer term basis, it might look a little bit stretched or overbought in the short term, but longer term here, it's just breaking out above the 2021 highs. So typically when you see these really important technical breakouts, momentum tends to continue. And that's our expectation for this trend to remain in that rising price channel. The other big story with communication services has been the relative breakout. It was basically consolidating for part of the summer, springtime. You can see that in the middle panel versus the broader market. So holding up, but not trending higher. And we've recently witnessed a breakout in that relative trend. That suggests that this outperformance will likely continue, at least technically. And breadth, I know there's a lot of focus on the mega cap components within the communication services, but it's not just those names that are doing all the heavy lifting. You can see on that bottom panel, over 3/4 of the sector above their 200-day moving average. And I know, Jeff, you like the earnings story here as well. It's not just the technicals that look good.
Yeah, that's right. You've had a really good combination of reasonable valuations and above market earnings growth in communication services pretty much all year. The big concern here is regulatory, right? With both Meta and Alphabet / Google under some regulatory pressure. There's been talk a lot lately about Google having to break up and things of that nature. So we'll see where all that goes. And by the way, there's also a potential positive catalyst if TikTok is banned or slowed in any meaningful way. That could actually benefit both Meta and Alphabet. So we'll follow those stories certainly, but right now, if you just look at the pace of earnings growth along with valuations, the sector still looks good. Still like communication services. So Adam, it's been a pretty low volatility year. I mean, this chart really puts that in perspective. When you look at 2022, one of the worst years we've experienced in decades. No more. There's not much red on this drawdown chart on the bottom half of this slide.
Yeah, so the top panel is the CBOE volatility index, basically the market's expectations for volatility over the next 30 days in the S&P 500. Higher means the expectations are for higher volatility. And then the bottom panel looks at the drawdown for the index as well. And what we witnessed this year has just been a very low vol type of year. You can see that in the VIX trading well below its longer term average of around 19.5. We had a couple big spikes, notably in August, where we had maybe a little bit of a glitch with that 70, almost 70 reading intraday on the VIX. And then, of course, last week's, I think we went up to 28 on the VIX, about a 74% move. Oftentimes you see these big VIX spikes overlap with market bottoms. That was the case, of course, in August. But as you look back to your point, Jeff, about 2022, very above average volatility and a pretty significant drawdown there for the S&P 500. And what we know about volatility, it tends to mean revert. So we've gone from high vol to low vol. And I think maybe next year we can expect more of a normalized type of volatility with the VIX trading, call it around 20, as things revert back to their longer term average here.
Yeah, probably not another 2022. Maybe something that looks more like combination of 2023 and 2024. We expect more volatility, but we're losing some of our potential catalysts for volatility in terms of the Fed, we think, and rates. We expect the Fed and rates to kind of cooperate and not be much of a catalyst necessarily in either direction next year. And that's going to leave, geopolitics is certainly a catalyst for risk and potential sell-offs. And then, like I mentioned before, the tax negotiations, policy, tariffs, all of that is, potentially a cocktail for some volatility. So we'll look at those areas very closely as we move through the year as potential opportunities to buy a dip. But for now, we think neutral is the place to be. And, hopefully we'll get an opportunity to be more aggressive in early 2025. So talked a little bit about yields already, Adam. I call this range bound, but actually, we have come down quite a bit from where we were, 12, 15 months ago. It's a breakout, but it's, there's still higher levels of resistance if you go back. How do you interpret this recent move above the more recent highs?
So I think you have to frame it up from a time perspective. Longer term, I think the heading here, range bound, makes sense. We haven't broken out through those October 2023 highs, nor right around 5%. But on a short-term basis, I do think there's risk to the upside here for 10-year yields. Technically, we've reversed a downtrend. We're back above the 200-day moving average. And then last week's breakout above 450, that's the highs that you can see, that resistance level that we highlighted there. That checks the box for a higher high. So part of the definition of an uptrend, higher highs, higher lows for yields. Now, evidence is growing that there's a developing uptrend or a shorter term uptrend here, with implications that we could go retest the April highs around 474. I think that could put some pressure on equity markets if we get there. Of course, if we clear 474, that could open the door for a retest of that 5% level we saw back in, again, 2023. take it one step at a time, though, with resistance. We're also kind of battling the gravitational pull from Fed interest rate cuts next year. So I think that could put a cap on where things are at. And then, as we witnessed even last week with inflation data continuing to at least move in the right direction, I do think there's limited longer term risk here for yields. But on the middle panel, we highlighted the term premium, and this is something our chief fixed income strategist has highlighted about the rise in term premium. And that's a model estimate of term premium, as we don't really know the exact number. But when that's moving higher, that's the incremental yield you investors require for adding longer duration. Part of that story on the term premium, of course, maybe it's due to rising deficits, what's going on in inflation, some of the break-even rates moving higher a little bit. What's been a little bit more notable just recently as well is just the City Economic Surprise Index. So as that moves higher, that means the economy is coming in above analyst expectations, moving lower, vice versa. And that's been the case over the last few weeks. You can see it dipping down to 10, coming from as high as 50 back in November. And that's been correlated to yields. That correlation is starting to break down a little bit, suggesting this latest move in yields not really predicated on higher growth expectations, but maybe some more to do with inflation. Of course, the Fed talked a lot about that last week, and then maybe some of the deficit, tariff concerns, things like that. But for now, I think there's a little bit upside risk to call it 474 on the 10-year.
Yeah, as our fixed income strategist Lawrence Gillen's been talking about, we do have Treasury auctions that we're going to have to digest next year, and we all know about the deficit spending, which is probably a big part of why yields have ticked up a little bit here lately. But on the inflation front and the growth front, we think we're going to get some help, right? In fact, our chief economist Jeffrey Roach thinks we're going to get a one handle on core PCE in the next like 4 months, we'll say 4 or 5 months, and I mean that's a meaningful improvement from where we are right now. That should put some downward pressure on yields. And then in the durable goods numbers today, we got a little bit of a hint into slower growth ahead. In the 2025 outlook, we cite some reasons why we think consumer spending is going to slow, right? That can put some downward pressure on yields. And then lastly, if you get higher yields, they become more attractive to buyers, pension funds, foreign governments, et cetera. So we think we'll get enough support to keep yields kind of in this range. Yeah, maybe we test 5, but our year-end target is 375 to 4.25 for the end of 2025. We don't think we're going to stay up at those lofty levels if we get there. So couple more charts, Adam. This is a measure of consumer bullishness on stocks, and it's pretty stretched.
Yeah, it's a little busy when I look at it again here. There's a lot going on here. Top panel, S&P 500. The middle panel uses the Conference Board's data, basically the household survey, looking at how many households expect stock prices to increase over the next 12 months. That is in blue. The orange is how many households expect stocks to decrease. And the bottom panel is the spread between those two, just to give you some indication of the bulls versus bears here at the household level. And going into 2025, right now, the consumers have never been this bullish on equities. So that is the highest reading. We had a 57 print in November. The data actually came out today. It moved down to 53, but historically high sentiment or bullish sentiment for equity markets. And it's not just the Conference Board data. You can look at even at the institutional level, the Bank of America Fund Manager Survey, one that's often cited, record low levels of cash, record high positioning in U.S. equities. You can look at magazine covers like Barron's. I think it was last week, they talked about another 20% year and embrace the bubble, I think was the title used in that one. So there's a lot of signs of froth going into next year. And I think you have to look at that a little bit from a contrarian perspective as we move ahead especially with the rally that we witnessed in equity markets.
Yeah, certainly some of this sentiment looks like it did in the late 90s. Of course, that rally went basically 4 years, not just 2, which is kind of where we are right now. So we'll see how long this run goes, but the stretch sentiment is certainly a key reason why we think we're going to get a pullback here. So I think it's your last chart, Adam. This is gold. I mean, speaking of sentiment, there's been a lot of excitement in the gold trade this year, no doubt.
Yeah, an interesting one, especially as the backdrop we just highlighted with this extreme risk on bullish sentiment. Gold often considered more of a safe haven, but actually outperforming the S&P 500 this year. And the story for gold started earlier when we finally broke out above 2070. That's that red bar going across most of the screen. That was a record high breakout. You can see how many tries it took gold to finally get through that level. And it's been really off to the races since we broke out in gold. And it's been an interesting backdrop when you think about gold rallying, I think up 27%, I think as of Friday. That's topping the S&P's return as of Friday as well. But you've had, again, rising yields, real yields as well. You've had a rising dollar that cleared 107 last week. That was notable. But yeah, gold's still trending higher here, retesting the lower end of that price channel. And if you think about the catalyst behind why gold is moving higher, against that backdrop, you've had record levels or near record levels of central bank buying as they diversify away from their dollar in terms of their reserves and add to gold positions. You've had a return of ETF demand coming in as I think fear of missing out started to play out in gold. So investors chasing this rally via physical gold ETF holdings. And then just the geopolitical backdrop. We've had elevated geopolitical risk really throughout the year. That hasn't gone away. So I think that's also helped prop up gold here. And an area that we've liked, I think, over the last, call it 2 years now with precious metals.
Yeah, gold's advance has been really impressive given that the dollar's been so strong, because usually it moves in the opposite direction. I think you hit on it right there, which is the geopolitical risk premium that's still in markets. It's come off a little off the boil lately, and you can see that in this little bit of a pullback in gold. But yeah, still an area that to us makes sense to have a little bit of exposure as a potential volatility dampener or diversifier. So really nice looking momentum there in 2024, certainly from gold. So thanks for that whirlwind tour of charts of 2024, Adam. That, of course, there are others that could have made this list if we went longer, but those were really great job sort of summarizing the year. So in terms of the holiday shortened week, there's really not a whole lot going on. So I mean, I did allude to the durable goods report. So you see here the orders were pretty weak today, down 1.1%. Headline, which is quite a bit worse than expectations of down 0.3%. And then if you exclude transportation, down 0.1% versus expectations for a gain of 0.3%. So orders is kind of forward looking that, those orders eventually turn into shipments, which is what goes into GDP. But, the all indications are we're going to have a strong Q4. GDP is tracking to around 3%. So we'll have to wait till next year for the slowdown. But we do think it'll come, not fall off a cliff, but maybe go from 3 to 2 in terms of the growth rate. So other than that, I just think, it's about consumer expectations with the conference board, a little bit of housing data and claims, which matter now maybe more than they usually do. Anything else on your radar for this week, Adam?
The Santa Claus rally period kicks off this week, actually tomorrow. So keep an eye on that. If you're not familiar with it, it's the last 5 trading days of the year plus the first 2 trading days of the new year. So officially that starts tomorrow. When that period is positive, it tends to produce historically above average returns in the following year. As of last year, for example, if Santa shows up, we get a positive Santa Claus rally period. The S&P higher just over 10% on average the following year, going back to 1950. When Santa doesn't show up, average returns for the following year, just over 4% with a much lower positivity rate. So let's hope Santa shows up this year.
All right. Sounds good. Rooting for Santa. I think the fundamentals, the market backdrop all supports just a little bit of a quiet drift up over the next, 7 trading days. right? The Santa Claus rally is the first 2 trading days of 2025, right?
Yep.
Perfect. So there you go. I think we'll go and end there. So thanks, Adam, for walking through the charts. Really great stuff. Thanks to all of you for listening. Thank you for listening throughout 2024. This isn't our last one of the year. Adam and I will be back next year, or next week rather, and then we'll have the first market signals of 2025 the week after that, and we'll get back into our regular rotation. So everybody enjoy the holidays. Good luck with that last minute shopping, and we'll see you next week. Take care, everybody.